Hello everyone, this is Terry with Futures.io, and as always, I would like to thank you for joining us today. It's my pleasure to welcome back John Grady from No BS Day Trading for today's webinar, The Evolution of HTF and Its Impact on Retail Traders. Throughout the webinar, please feel free to type your questions in the questions box, and we'll answer them at the end of the event. If you're watching this video on YouTube, please do us a favor and give us a thumbs up if you enjoyed the webinar. And as always, please feel free to share, comment, and subscribe to our channel. It really helps us a lot. For trading news, events, and information, follow us on Facebook, YouTube, and Twitter using @Futures.io. And now, without further delay, I will hand it over to John, and you'll get the pop-up to share your screen again.
All right.
All right, looking good. She's all yours.
All right. Thank you, Terry. Thank you, Terry, and thanks to Mike, as always, for having me back. This is my homepage, just for anybody who's interested, doesn't know who I am. This is my blog page. A lot of free information on the site. Anyway, if you want some more information after we are done today. So the topic today is the evolution of high-frequency trading and its impact on retail traders. I'm always trying to find basically different ways to, kind of say the same thing about the order book and order flow and why people should watch it when they are day trading. And so I thought what I could do today is I can break down sort of how it came to be. Now, obviously, we're on a time limit, and I can't cover the entire history of HFT in 30 minutes. But I'm going to break down the basics, essentially, to help you understand how it came to be and why it's important, and sort of convey it in the most simplistic terms that I can. All right. So let's have a couple notes that I usually keep up to keep me on track so I don't digress too much. And then I have some screenshots, and then we will get to a few trade samples at the end here to kind of show how it comes into effect in real time. All right, so I would ask, if you're already familiar with some of this, just stick with me. A lot of people are not aware of what I'm about to share. So I'm going to lay out the basics, and then we'll see some trade samples. So in the beginning, right, prior to online trading, what you basically had was you had specialists on the New York Stock Exchange, and you had the floor trading and the futures pits. All right, so there's a reason that I'm going through this. The order book, when you hear people talk about the order book, all right, this is what they're talking about. They're talking about the ladders, the depth of market, the dome, whatever you want to call it, okay? Those are all terms for the same thing. And what it shows are the bids and the asks. Now, I have videos on my site, and there's some videos, Futures.io, that talk more about this. I have one video on YouTube that it breaks down everything you're seeing in the order book. If you have questions about it, definitely check that out. But the point of showing it today is that what you're seeing here is what was going on here back in the day. All right, so a specialist on the stock exchange would have access to the order book, and he would run the order book usually for several different stocks. So for example, what happens is a broker comes in, he needs to execute an order. Somebody wants to buy 500 shares of a stock. All right, let's say they want to buy 500 shares at $19. The specialist would look at the order book. He would see what was for sale. He could also make his own price if he wanted to sell it himself. And so he would match the orders, right? So somebody comes in, I want to buy 500 shares. The specialist says, I'll sell you 500 shares at $20. Okay, order done, transaction done. One guy's long, one guy's short, right? It was a huge advantage because the specialist could see all of the orders that were sitting there. So if a very big firm, let's say, had an order come in and they want to buy 20,000 shares at, let's say, a price of $20, the specialist could see that, and he could step in front of it, and he could buy 1,000 shares for himself or 2,000 shares for himself at $20 and a quarter, let's say. And then as the big order was being worked, the price would go up and he'd make money, and vice versa. Now in the futures pits, different story. you have a bunch of people that were standing around and they're all screaming and it's open outcry. So there's no specialist working a book. Everybody is just making a market in the chaos, and it certainly was more of a free market type system. Guys are filling their own orders and making their own quotes, right? So a different thing, but you still had the same process, which is guys are offering to sell and they're bidding to buy, and then they match their orders, and then price fluctuates, right, as a result of all of that. So when the market started to go online, more and more people gained access to being able to place orders directly themselves online, all right? And as that happened, what people began to figure out is that you had an advantage working online if the liquidity was there, because you could act faster than floor traders could act, all right? So this is one of the points that I want to make. So in the beginning, what would happen is a floor trader, let's say a smaller floor trader who was only trading maybe 10, 20 contracts, usually, he would be looking for a guy that might be willing to buy 500 contracts, and he would try to buy in front of that guy. And then if the market doesn't go, he would just turn around and try to work the order as a break even, all right? And I'll show some examples of this on the ladders. So everybody could see everyone else. Well, what happened is as the exchanges went online, people were able to hide what they were doing. So you might have a guy that was standing in the pit and he's showing that he wants to buy, let's say at a price of 10, but then he's working an order on the screen. I'll show you this. This is more modern day, right, before they closed, at 11. And so maybe he's bidding in the pit, but actually he's trying to sell on the screen. And when his order gets filled on the screen, he lowers his hands in the pit. He's no longer looking to buy in the pit, right? And so there were ways for these guys to try to work around the pit and move price in a certain way, and they would play both the pit and the screen. Now something, and I always show this because it illustrates the importance of watching the order book, is you notice these are the screens in the pit. So the guys were watching both. They had handhelds. They would trade off the screen. They would trade in the pit back and forth. All right. Now, so what happens is in the beginning, you had a very few platforms. The pioneers really, there was a platform called Watcher for stocks. I couldn't even find a picture of it. I kept looking online and could never find a picture of it, but it was a thing. It was really the first solid level 2 for trading stocks. And then you had TT, Trading Technologies, which kind of pioneered the ladder format for futures trading. And in the beginning, very few people had access to the platforms. They were expensive, and also very few people could afford the connections. So for most people, you needed like a T1 line or some kind of a virtual private network line, or a private line that would run into the exchanges, and those could cost, you know, several $100 a month to several thousand a month, depending on where you were and how much it costs to run the cable. So today, when people kind of talk about the struggles in trading, while they certainly exist, obviously, newer traders have no idea really what they have access to today in comparison to what things were like back then, you know, and the cost is minute compared to what was going on back then. So back then you had to spend probably $2,000-3,000 a month just to have the platform and a decent connection to the exchange, so that you would have decent speed and you wouldn't be in the middle of a trade and then lose your connection, right? And you lose money on your trade because you can't exit. So things have definitely improved on that front. However, and back in the day too, you could have multiple traders working together, again, on the floor and on the screen, to capture inefficiencies like arbitraging. So you might see a bid on the screen and offers in the pits, and you could buy in the pit, sell on the screen, and instantly capture a take a profit, you know, or more, depending on the market, and do an arbitrage strategy. So what happens is, as time progressed, more and more people began to figure out that if they could program a system that could move faster and read the volume faster than humans could, then it would be a huge edge, okay? So what does that mean? What I'm about to show you here, and again, bear with me if you already know this, but a lot of people don't. I'm going to show an extreme example because I just happen to have it on recording. But it's really excellent just for sample purposes. You don't see this very frequently. This happened last year when the S&P, when the stock indexes were going crazy, going haywire with a meltdown. So on the right side of the screen, this is the ES. And what you have is these small size, right? 19, 50, 7, 53, 31. You don't see 150, 200, 300 at every price like you do today. Actually, this was several years ago. And so here, if you can see this, there's an order of 1,200 on the offer, okay? Now that's a very large order in comparison to every other order you see. Down here you see 226, which is pretty big compared to the rest. But here is 1,200. That's much bigger, right? And sometimes when you look at crude, you'll see stuff like that. You know, the occasional price will have 600 up versus 10 up or something like that. And so it varies from product to product. But what I'm about to explain to you is something that every single retail trader should understand, and yet probably 80+% don't understand, all right? What an HFT program is doing is it's reading the orders in the book, and it will spot that 1,200 on the offer. That's a very big order. The only way the market moves higher, the only way price moves higher than 42.50 is if enough buy orders hit that sell order to get through that 1,200, okay? So if you don't have enough money out there willing to buy 1,200 contracts at 42.50, it doesn't have to be one person, it's not one person, but I'm saying overall, the market won't move higher, okay? So when people are firing just based on charts, and this is where like I get into debates with people about chart trading, and they say, well, why can't I just watch a 1-minute chart or a 2-minute chart or whatever? This is why, because if you're looking at a chart, you're not seeing discrepancies like this in the order book, or imbalances is really what they are, all right? So what's going to happen with an HFT or these algorithms, it depends on the programmer. HFTs and algorithms lose money all the time, okay? You have to have a good programmer still for this to work. But what it's doing is it will spot that order, and then what it will try to do is if the order drops from 1,200 to 1,000 to 8 to 6 to 5 to 4 to 3 to 2 to 1, right? It will try to buy 2 or 3 contracts as it goes through the very last amount of contracts. So the HFT might watch it go from 1,200 all the way down to 220 or 180 or 150, and then execute to buy 1 or 2 or 3 contracts. All right, and if it gets to fill and it goes long at 42.50, the expectation is that the market will then jump through that because other people are also going to be doing the same thing. So if that order gets cleared, automatic orders should also hit 42.75, 43, 43.25, and 43.50. Okay, so as it pops, if the HFT gets to fill at 42.50, frequently it immediately offers out 2, 3, 4 ticks higher and just captures the money on small size. And it will do this over and over and over again throughout the course of a day. So a lot of the erratic behavior, and the reason you see a lot of chop sometimes, is because you have these HFT programs that are only going for 1 or 2 ticks, and they're doing that all day long. And if they can't get the 1 or 2 ticks in a matter of a couple seconds, they just bail out and they try to scratch the trade at break even or lose 1 tick. Okay, so let me show you what I mean. Watch as the market moves up. They're going to hit this 1,200. It'll go through the 1,200. It'll spike up, and then it kind of spikes around for a second, but you'll see what I'm talking about. It'll trade up right here. So right there it's printing, and you can see that it's printing at 42.50. I paused this is a video that I had paused. I'm going to show you. It'll go here in just 3 seconds. And that last 1,000 right there, they're going to eat through. And when they do, you're going to watch it spike. See that? Okay. So there's probably a little bit of a lag, but I'm going to break it down. This is where the 1,200 was. There was actually more than 1,200 there. As you see, there was over 1,400 there. When they eat through that order, what happens? Immediately the market spikes up 6.6, right? So the HFT, most of them, what they're doing is they're reading the big order. They're trying to buy it as it gets filled, as it drops from 8 to 7 to 6 to 3 to 200. They get their fill on 2, 3, 5 contracts, and they instantly offer out, and they get the fill as the market spikes through. Okay, and they capture their whatever, $100, $200, $500. Okay, that's what HFT programs are doing all day long. Let me bring up my points here. So when it began, what happened was if you were fast, and I worked in an office when all this was just starting, so I'm familiar with Watcher and TT and all the ones that come along behind it. That platform that you're seeing is the Jigsaw trading platform. That's what I use today. I like it better than the others. So a little plug for Jigsaw. But when it began, you could see the 1,000 drop. So you could watch it go 1,000, 8, 7, 6, 5, 4, and if you were quick on the mouse, you could click into that, and you could get the fill by manually point and click. Okay, manually pointing and clicking. As time progressed and the connections got better and the signals became faster, the program started acting faster, and they could hit obviously faster than a human could. And that's really when a lot of those obvious inefficiencies disappeared. And the game changed somewhat. And so you have programs going back and forth all day, and they're fighting against each other, and they're looking for big orders, small orders, areas of momentum, so on and so forth. All right. So that's what they're doing. In case you were wondering, that's what's happening. Again, as the infrastructure improved, the big firms began to dominate due to their speed advantage. So you can watch some shows on YouTube. There's a few things like Inside the Black Box and some other videos on HFT, and they're really good videos. And again, I'm simplifying, and there's or just breaking it down to the basics. But literally, it got to the point where sometimes milliseconds would matter. You know, now if they run up against a huge order, it doesn't, because the guy sitting there will buy or sell as much as anybody wants. But you know, you play the odds and the statistics, and you try to make a trade like that 20 times over the course of the day. Even if it only works 10, usually on the other 10 trades, you can break even or lose less than you make on the 10 winners. You know, and so they'll do that 20, 30, 50, 100, even 300, 400 times a day sometimes, depending on the product. So everything goes global. Everybody starts to have greater access to the market. Your liquidity increases, right? More and more people are playing in the game. And it also offered itself up to multiple firms, or one firm, excuse me, being able to use multiple offices to work strategies at the same time. All right, so what could happen is you might have a firm that has offices in Singapore, London, New York, and Dubai, let's say, right? And in order to try to hide what they're actually doing, or what they want to do from a long-term perspective, let's say, and maybe over the course of the next 5 minutes or over the course of the next hour, they will work orders from all 4 different offices. And they can do it, obviously, online, and they can work some on the bid, some on the offer, some on the bid, some on the offer, and they're also executing at faster speeds than most retail traders can execute. And this is why you see the movement behaving so fast, right? And why your eyes sometimes can't keep track of what's going on. All right, so that's the very short version of the or our very brief history of HFT and what happened. And people became, I guess I would say, the smarter individuals who were being hired and recruited were the people who understand the game theory of it and the poker aspect of it, and they understand how to design systems that can take advantage of that type of information, but also stay out of what I call bad action. And that's really what separates good algos from bad algos. The ability to understand when things are just too chaotic or maybe too slow, let's say, and there's no real advantage to running your program during that period of time. So the reason a retail trader needs to understand this is because you have to realize how much of an impact that has on the overall movement. Okay, so to develop a short-term profitable strategy, you need to know that, because obviously as a retail trader, now that was chaotic and I was staying out because it was so chaotic during that time period. I prefer a little bit more methodical type situations. But if you're trying to take advantage of movement, you also need to be aware, all right, if that 1,000 gets cleared out, the market's probably going to jump right through it, right? Now, whether you yourself can design a system that can execute fast enough to get a piece of that or not will depend on who you are and where you live and your connection speed and all that good stuff, right? But you want to be aware of it. So you're firing blind often if you're not paying attention to what's going on in the order book. So let's just take a look at a couple of different trades and how you kind of can sense this in the moment yourself. So this is at 9:06 a.m. This is prior to the 9:30 normal open for the stock market, right? So on this particular day, the market was moving lower. This was the overnight low, and I thought that the market might break the overnight low. It certainly had the potential to do it. But if you watch the activity here, what you'll notice is that you don't see a lot. I haven't started it yet, but I will in a minute. You're not going to see a lot of movement in terms of activity. All right, so if we watch it trade, it's a little bit slow. There's not a lot of volume. And it's going, like it's open, but you just see a few contracts here, a few contracts there. There they sell kind of at the lows right there. A couple of orders hit the bids. I worked just a quick order to sell a couple contracts and see if I can't maybe get a few ticks as it goes to the low. But what you'll notice is that you don't have a barrage of sell orders suddenly hitting the bids, right? And so for me, that's not really a good sign, because that means you don't have many programs currently activating and immediately taking out lows. So when I see that, I know that that's not really a good sign if I'm trying to take a short trade right here. And I can see that it's a little bit slow, and sometimes the ES takes a couple seconds to move or a minute or two to move. But basically, that's not what I want to see right there, right? I don't want to see it print and then some orders come back in trying to drive the market back up a little bit higher. So that's not a good situation. And I know that if the automatic orders keep hitting the offers, I'm going to be sunk on the wrong side of this. And so, for example, right here, there's 357. Someone has to hit that, right, in order for the market to drop back down. So if the market doesn't clear through, which it did right there, if someone hits it, there's no way I'm getting paid on this trade. And essentially what happens here is it's so slow, and I can see that the HFTs aren't there and they're not triggering. And it makes sense because it's early, it's not 9:30 yet. But sometimes you do get pressure at these points earlier. It's not really breaking. And so what ends up happening is it kind of bounces around here, and I was looking for it to just go lower, and it just won't. And so to a lot of people, this seems crazy, but right there I scratched the trade. Now that's the difference between a scalper mindset and like a longer term or swing trading mindset. The way that I'm thinking right there is I'm thinking, trying to think like the programs are thinking. And if I can anticipate the fact that, all right, the programs are also going to read that the market took out lows but didn't go farther, then they might start to buy back up again. And I could be caught on the wrong side of a trade, and it's just not really working in my favor. So I don't need to hold the trade for a loss. I don't need to sit in it till 9:30. I took a shot at it. It didn't work. I scratched the trade. All right. That's the way that I kind of approach those situations. Now, if I jump forward, let's go to a time period when the markets were open. Here it's 9:51, different day, obviously. I end up taking a short trade. Same kind of situation. There were other factors in the equation, context-wise, that made me think they would break lows. But I'm still looking for kind of that barrage of sell orders to take out lows and hopefully do it fairly quickly. And then hopefully there's a feeding frenzy that starts based on that. All right, so right there, I end up selling 86s. And what I'm looking for are the programs to basically sweep the lows. Now, right here, you'll see there's a big order of 730. Again, I know programs and even discretionary guys, whatever, they have to sell through that for me to get paid. So if it goes down here and it touches the 730 and it only trades 10 contracts and it comes back up, it's just not going to go, right? So there has to be enough pressure there to get through the 730 for the market to break lower. And if it does, I want to see it break quickly on HFTs hitting the next bids underneath it. That's the idea behind it. So even that can seem crazy. I move my stop to a break even, but I move it to a break even because I know they got to get through the 713. It might have been a little close for this trade, but it works. If they can't get through that 716 right there, I'm not going to get paid, and I don't need to sit in the trade. And so right here, that's what I'm waiting for. Now, you'll notice a stark difference between the amount of volume that's trading in here at this period as opposed to the last sample, right, where it was pre-930. And so, you know, even in here, what most people don't realize is that a program might make 5 trades in this mess. It might go short 85.50, cover 85.25, then go short 85.25. It can't get the fill at 85, so go scratch, but then go 85.25 again, see if it goes again. And they might go back and forth 3, 4, 5 times. And that seems weird to the average retail guy, but that's what's actually happening. And so that's why you get feeding frenzies sometimes and other times you don't. And that's why when you're trying to predict where the market's going to be in 2 or 3 hours, it's a lot more difficult because so many programs are responding on a second-to-second basis. And then they just create a domino effect. So here they clear out the 400. And then you see it sinks a little bit lower right away. And I move my stop down to try to make sure I lock in some profit no matter what happens. And this wasn't a big snap. It wasn't a really volatile situation. I'm sure everybody in here has watched the ES. Sometimes the ES can snap 8, 10, 12 ticks really quickly on a busy day. Sometimes it's more like this. There's more volume there, so it takes more volume to get through. And that's what I was seeing. And then I decided to just go ahead and take the trade off. I thought it might bounce back a little bit, and it actually did. It turned around right there. But the whole idea is I'm just responding to it kind of like an HFT situation, all right? So to jump forward a little bit farther, let me show you guys, I'm going to show you guys a losing trade because sometimes people are fond of saying, you know, you're showing winners, not showing losers. And that's not what I try to do. I try to pick samples that illustrate the point I'm making during the presentation, okay? So This is a trade in the 10-year. This is what we're looking at over here on the left-hand side. All right, and the 10-year is currently trading 11.5 by 12. Same thing happened in treasuries. They're just much more liquid, obviously. And so what will happen is you might have an HFT program that's trading a 5 lot or a 10 lot. Excuse me, sorry. And what it will do is it will read this order right here. You can see there's 39.98 on the offer. And if that 4,000 roughly drops down to, let's say, 400, the HFT will try to buy a 5 lot, let's say, as that last 400 is getting taken. And then hopefully the market bids up and it can offer out and get 12.5 and scalp a tick. And if it can't, it often will just offer out again and take the scratch trade. So in this situation, I thought the market might break highs. And so this can obviously happen at times. They're going to print, and what happens is you're going to see there's an iceberg there. That's called a refreshing order. It's going to trade up, and you're not going to see 4,000 trade. You're going to see 10,000 trade. And you can follow that over here even. You're going to see it on the inside, but you can see 44.26. That's the total that I traded up to that point in the day. And I see him go for it, and I end up joining a little late, but I get the fill no problem because there's 10,000 there. All right, so I execute, and I end up buying, but I also wasn't anticipating 10,000 being there. So you can see a total there of over 10,000 contracts trade. That was at 4,000. Now it's at 14,000, right? So when I buy in to a price like that, and I see that suddenly there's not 3,000 or 4,000 there, there's 10,000 or 11,000 there, what that lets me know is that there are other HFTs that are going to see that as well, and they are probably immediately going to offer out to try to scratch their trades. So as they do that, there might cause pressure to come back the other way. And if this market doesn't move back up in my favor fairly quickly, I don't hold the trade. And so what happens is it trades back and forth a little bit. And I tried to give it some room. I'm fast forwarding here a little bit just to speed up the process. I'm fast forwarding a little bit, and I set in the trade, and then you can see it drops against me. And the reason it drops against me is because there are orders that there are other programs and traders who all saw that. All right, so they can see that they buy into 12. They can see there are 10, 11,000 there, not 4,000 there, and they respond by immediately turning around and offering to sell at 12 or sell at 11.5. And that can cause a chain reaction going back the other way. And sometimes, depending on context, I will give it some time, which what I was trying to do in this trade, to see if it would go. And they did bid 12s there, and then they offer down, and I'm pretty sure that they're going to go lower. So I tried just to work for a 1 tick loss at 11.5, and I get the fill right there. And I take the 1 tick loss, okay? And for me, in this particular situation, that's the right play. Now on this day, it ticked down from there farther. Let's show you, scroll through. You see they were hitting 11s, so it was moving farther. On this particular day, it traded in that area. It was very choppy, and it did eventually go higher. But I have plenty of other samples where I take the 1 tick loss, and it's the exact right call because the market then turns around, goes the other way, and drops in 4 or 5 ticks. All right, and sometimes there's even a play for a reversal in a situation like that where I go from long to short. Depends on some other factors. But what's important for a retail trader to understand is that the back and forth there happens because you have programs that all go for that 4,000 at the same time, but they don't find 4,000 there, they find 10,000 there. Okay, and then that 10,000 causes the program to turn around and try to scratch or go the other way and actually go short. And they may go back and forth a couple times in that same area. So that's the general gist of all of it. That's how it works. I think I covered all my points that I wanted to make, and I guess the main idea behind this presentation is, as usual, if I'm talking to screen trade or I'm talking to retail guys and they want to learn more about how the markets work and they want to understand more about the ladder and the depth of market, and of course they ask me, well, why do I need to watch it? That's why. You end up missing a lot of information. So for example, to just be honest, or to take it back, in the day, if a guy was sitting at his house and he's just watching quotes on his computer, watching the last traded price, let's say, of the futures price, he can't see, or he could not see what all these guys in the pit could see. He couldn't get the vibe of the pit, how much action there was, if nothing was happening and everybody was on lunch break, right? He couldn't see if a big broker was coming in with an order of 2,000 contracts. He couldn't see any of that. He's just flying blind, basically looking at price and charts. And so that's why these guys, and guys in the pit lost money too, but they had way more of an edge than a guy sitting at home. So what I always say is, if you're watching, even if you still want to look at the charts and maybe some fundamentals, you also want to watch the ladders, because you can see information in the ladders that you can't see in the charts and the indicators. Okay. All right, Terry, let's do Q&A.
Okay, if you have questions, start typing them in and I will ask them.
I'm here. I'm going to take a drink of water real quick.
Okay. From what you explained, the HFT will go through a level but will not continue and initiate a big drive. They play for a couple points. How do you decide to keep with the trade and play the breakout versus play with the HFT for the quick drive through and revert?
So for me, that delves a bit more into the overall bigger picture conditions. So for example, knowing that the HFTs will get in and out of trades like that, you can also anticipate that they're going to probably keep going the same way. So the HFT might be, or the combination of programs might be going for 2 or 3 ticks, but once they exit, if they're still reading an overall bias to one side, the trend, let's say, they just go they go the same way again and again and again and again. So they might, for example, if we're looking at one of these samples here, right here where I was, they might sell 86, cover 85.50, then sell 85.25, cover 84.75, sell 84.50, cover 84s. So that it's a little hard to convey, obviously, in today's presentation, but basically it's all about what I call context. And I would, like, if you have any questions about that, check out my blog. I actually have, the last one I posted was about context. You're looking sort of at the bigger picture at that point, so you're not just functioning on bids and asks or profile. You're also kind of looking at conditions, right? So if a news report is just released at 8:30, you're much more likely to have either a continuation or a strong reversal than you are at, let's say, 11:30 a.m. when nothing's happening. And you have to factor that into the equation.
Okay. Was it the lack of back ticking that made you disqualify that first trade on the ES that you exited, aside from the context of the morning?
The first trade, this one here, 41.50s.
Yes.
Yeah, well, for me, I scratched it because it didn't go. So for me, it was not. It was that it didn't. I have a certain idea of what should be happening, as should every person who trades. So before you enter a trade, you should have a really good idea of what to expect based on your assessment of it. And in this situation, it was just, I knew it was pre 9:30, so I know it might be a little slow, but I was, for my particular read, as you can see, I mean, it already bounced against me a little bit, and then it comes down, and then it just won't go. So I had a certain time frame in my head where I knew that it should go, and if it wasn't going to go, I would just exit. So I was looking for a quicker follow through, like what happened with that trade over here, and it wasn't happening, so I just took the trade off.
Okay. If you have any other questions, be free to start typing them in. I'll give you a few more minutes to get them in.
Yes, please feel free to ask if you have anything else you want, anybody out there.
Do you ever find that markets move too fast to get a good read?
Yes, absolutely. That first sample is a great sample of that. I mean, I happened to have this on recording. I was recording when it was going on because I knew it would make for good footage. In this particular situation, I mean, you have that, let's say that order of 1,000 there. Let me find, scan forward. But realistically, you know, this market, like if we watch it for just a couple seconds here, that's chaos, and that's you know, a combination of a few firms for the most part, and they're probably firms that normally would be comfortable trading 20, 50, even 100 contracts, and they dial it all the way back, and they're only trading ones and twos. You know, so that's why your liquidity goes from 300 by 300 to 6 by 6 there. So that kind of movement I find to be not conducive to making good reads. And of course, it can also be too slow as well. It can just be dead, and there's no volatility, and there's nothing you can do.
Okay. Is it still possible to be profitable for a beginner trader today?
I mean, I think so. Yes. I mean, yes, it definitely is. I know people who do it. You know, the thing about it is you just have to approach it from. You have pros and cons. So again, the pro is you can trade from anywhere in the world, and you can have a fast connection, and you can have the lowest fees that have ever been available to retail traders, and you can have a great platform for an extremely cheap amount of money. So those are all the pros. The con is the speed, obviously, right? So if you're trying to beat the program that's running by a firm that has a direct line to the CME servers, your order is going to hit after it hits. But what you basically, the real key to profits is you just have to find an edge and then wait for that spot. So I guess for newer traders who are wondering, you can definitely develop profitable strategies, but then you have to stick with that strategy, you know, and sometimes it doesn't work, and you have to bow out when it doesn't work. So because conditions change. So that's a different kind of topic altogether, but that's what it boils down to in the end.
Okay. I find it difficult to trade right before the open because the way price can surge and become suddenly volatile. Is this because of HFTs or something else happening in the order book?
Yes, well, it's because um, most of the orders are going to respond to what happens in the cash indexes. So since the actual stocks often don't get moving until 9:30 exactly when the bell is, you know, rung, then you don't have the same amount of activity in the stock indexes, let's say. So it only makes sense. So up until 9:30, you primarily just have a few firms working orders in the ES, and then maybe it's responding to European movement, you know, what's been going on in the European markets overnight. And then at 9:30, when the stock indexes or the main stock markets open, suddenly a wall of, you know, activity occurs, and things get busy. So yeah, I typically recommend people don't trade the open, or like, you know, 9:25 a.m. to 9:35 a.m. period. because it's a little bit too erratic, and it's because so much volume hits in those first few minutes.
Okay. Is there any way to anticipate that volatility?
Uh, yeah. For example, today is an FOMC meeting today, and also tomorrow, and then tomorrow the announcements at 2 p.m. So typically on FOMC days, it's not that you don't have any movement. It's just that you tend to see more liquidity and less erratic behavior, So typically you can sometimes anticipate based on what news is going to be released, if any. And then also just looking at the book right off the open at 9:30, does it suddenly pick up and you see quite a bit of liquidity, or is it thin? And if it's thin, you can expect bigger moves, obviously, and if it's thicker, you can expect less volatility overall. I mean, right before 9:30, it can be hard to tell. It depends, but usually within a couple minutes, you can figure it out.
Okay. Are fixed income products, in your opinion, better for junior traders?
Yes. The reason being, even though they're slower, the liquidity allows you to see where real size is trading versus not as much size. And the other difference is that they're not subject to the cash indexes. So with the ES, you have literally several million people trying to trade stocks and the stock indexes and the futures, and thousands of HFT programs around the world trying to scalp those ticks and follow the cash index and take advantage of maybe inefficiencies or arbitrage type situations. And the fixed income products, you have a handful of players who do kind of the same thing on a daily basis or weekly basis at least. So I typically steer people towards fixed income treasury markets, at least in the beginning, to get a feel for what it's all about in terms of supply and demand in the order book. And if you can become somewhat proficient at treasuries, then maybe try your hand at the faster markets.
Okay. Do you in general measure exhaustion by observing volume drying up and momentum tapering off?
In general, yes. I mean, it again depends on the context. There are some days when it doesn't, like, let's say the market's moving higher and you may see a ton of size on the offers. It just doesn't matter. The market just keeps moving higher all day long because the fundamental driving force is there for it. Maybe that's a news event of some sort, or maybe it's because China's buying, whatever the case is, it just keeps going. But yeah, in general, you're looking for turnaround points just kind of when it stops, That's
Okay.
about it. Yeah.
You're mainly a scalper. For the average trader, isn't scalping difficult just due to the commissions/fees?
No, it's not. I mean, the fees are, you can certainly chop yourself up and churn fees, but you're not. I think there's a couple of misconceptions. One is that, and I just talked about this in another presentation. One is that you're not necessarily making 50 trades a day. A lot of people seem to think that. The idea of scalping is more about just getting what you can get, whether it's 1 tick or 10 ticks, and responding in the moment to what you're seeing in the moment. So yes, you might make more trades, and yes, you might not be capturing 30-point moves, but you're also not losing 15 points when you're wrong, and you're getting a better feel. What in my opinion anyway, is you're getting less random calls because you can see what's happening. So for example, on that situation that occurred on that day, guys can see the 1,500 or 1,000 there, and if you see that and you're able to take advantage of it in that moment, that type of a trade of buying that 1,500 as it's going away, expecting to spike through it, is a way less random result than trading off a head and shoulders pattern, let's say. You're responding to the here and the now. In the same way a quarterback maybe changes his call, right? He's thinking about passing and he sees a defense is set up for a pass, interception, or to pass defense, and he swaps it to a run play. So you're responding in the moment and trying to get what you can get. So yeah, you do have to be careful about churning too much, but obviously because I do it and that's what I teach, I feel that it's a better method of trading than most others out there.
Can you talk about when icebergs do have an effect and when not so much?
That goes, again, a little beyond the scope of today. It's more about context. You just have to, there's a little bit more of a feel involved there, if I'm being honest. It's experience. You watch the markets, and on a certain day, maybe let's say after a non-farm payroll report employment day, the market starts cranking one direction and it just hits iceberg after iceberg and it just keeps rolling through them, right? So if it's rolling through the icebergs, there's no point in fighting it. You just stay with the trend, until the trend finally loses some steam. So that's really how you want to approach it if you're looking at big orders. Just pay attention to the big orders, but also what's the bigger picture? That's a big key a lot of people lose. So I'm focusing today on sort of showing the micro picture and how the HFTs operate on a micro level. But again, that does have to be viewed within the macro perspective. And you put it all into like one part of, like, they're all pieces of a puzzle and you're trying to put the whole puzzle together.
Okay. Do you trade around economic news releases, FOMC announcements with all of the algo activity?
I do after the 8:30 and 10 a.m. reports, not after FOMC. It's a different ball game. It's late in the afternoon. I just don't like it, never have. But the 8:30 numbers, for sure, you always want to be there, and the 10 a.m. numbers, for sure, you always want to be there, but not in those first few seconds. The first few seconds, things are way too busy, and the markets get very thin. The liquidity, decreases, and you can get whipsawed extremely easily. It's a little bit too much of a guessing game. But once the volume thickens back up a bit, then that's when I prefer to go back into it.
So do you think market making techniques are much harder now to execute for retail traders?
Yes, I do. Because you're competing with guys who A, can obviously move faster than you, B, they get priority in the queue, which means, for example, I get this question a lot. Like, let's say you want to maybe sell 12 in the treasuries right here, and there's 1675 there, and it's showing you as being actually, let me find a different example. I'm trying to find in the queue. I don't think I have a position in the queue on any of these. Did I have one here? No, I clicked in. These are all market orders. Well, basically, let's put it this way. Let's say you offer out and it's showing you as being 500 in line. So in other words, if 500, you're a one lot, if a 501 contracts trade, you should get the fill, but then 700 trade and you don't get the fill. And you wonder, well, I was 500 in line, why didn't I get the fill of 700 to print? Excuse me one second. It's because the market makers get priority. So since they provide liquidity and they're in and out all day long, even if his order was placed after your order, he gets the fill before you get the fill because he's a market maker. So to try to compete on that level, plus market makers use different strategies. I mean, it's not just all for one tick. Sometimes they press in one direction, just like the outright guys do. But it's definitely, yeah, it's pretty hard to just try to work for ticks all day long. And also you need to have a seat to do that. You need to be on the board or the CME and be paying, only 20 or 30 cents a round versus retail rates.
Okay. Do you look at spreads to see the difference in relative value between the instruments? For example, would you look at the NOB spread before entering long or short the 10 or the 30 year to see which contract might be more expensive relative to the other?
So that again goes way beyond the scope of this presentation, but the short answer is that I'm able to follow what's happening in my head because that was how I started, was trading treasuries. I don't, for me personally, no, I don't have to look at the knob or the fight, which would be the 5-year, 10-year, to get a feel for what's going on in the spreads. I can get that feel just by watching the discrepancies and the order books. But I do pay attention to it overall, yes. So if I'm noticing that the spreads seem to be changing in a big way, that might clue me into which product I want to trade, or whether or not I even want to be involved. And if the spreads are staying in line, then usually I can just make the read outright. So yeah, it doesn't hurt to learn more about it and to know that it exists, obviously. There's also cash versus futures as well, but that's a whole different story altogether. So yeah, you kind of want to be aware of major discrepancies, but overall, you don't have to constantly follow the spreads to be able to make good calls.
Okay. I got 2 questions left, so I'm going to do these 2.
Okay.
Today on the Bloomberg China news, was that also HFTs and algos only, or was it also humans?
I mean, most likely both. It's usually always both. So don't have any mistake about it or make have any illusions about that. There's a combination of people and programs trading, and there are almost always people monitoring their program. So even if the program is running independently, there's a person there who can turn it off immediately or adjust it to adapt to the current conditions. So yeah, that breakdown, that's probably what you're referring to. What that really is people and computers, but it's what's the domino effect. At a certain point, right? So if the market keeps falling and falling and falling and falling, guys who are on the long side getting run over have to what I call puke out. They have to puke their position and exit for a loss. And so then they sell and they hit the bid, and then that causes more people to go short, and that causes more people who are long to exit, and so on and so forth, and the cycle repeats. So that's really just more of a domino effect, and it doesn't even matter whether it's HFT or humans. You just have to be aware that the market is currently plummeting and don't step in front of it.
Okay. And then the last question will be, this is, I guess, for me. What do you think the future for HFT is, and how will it affect retail traders?
I think it's just going to be more of the same. I mean, there's only so far you can take this, and people might disagree with this. This is just my take on it. I think we've about maxed the potential. I mean, you already have the connections there in terms of being able to move orders at almost light speed, right? And so everybody's always going to be fighting for that little bit of extra edge or a little bit of extra speed, but that goes beyond retail traders. So I don't think that we're necessarily going to see it get any faster. I don't think we're going to see more liquidity either. If anything, I think we've seen such a boom in the last 10 years and an explosion in prosperity around the world that liquidity has increased, maybe not to critical volume, but certainly I don't know how much farther it can go. So if anything, it's liable to back off a little bit, and liquidity might be reduced somewhat. But as far as the retail guy goes, I think like to try to answer as best I can. The important thing is to understand how they function And then what you want to do is, once you understand how they function, start learning how to anticipate direction during certain times in potential areas, right? So you want to start trying to figure out, is this the type of scenario where I'm probably going to see a lot of rapid fire HFT orders fire off in one direction? Or is this the type of scenario where the market is unlikely to do that because there seems to be more volume and the market seems to be less busy, and therefore there are probably a lot of programs that have already been switched off for the day, right? And you want to view it from that perspective, and then try to create your own edge and strategies based on that information.
Okay. Thank you for the webinar, for the information, and for spending some time with us this evening.
Sure, man. Thank you for having me as always. I appreciate it. And thank you to everybody who attended.